Good morning, everyone. Thank you for attending today's May 2024 webinar by Capital Management Corporation. Today with me, this is Scott Davila, and I am Vice President of Marketing and Client Relations. Today I have with me Tim Call, President and Chief Investment Officer, and Mark Livesay, who is Vice President and Portfolio Manager. Before we dive into the content, a few housekeeping items that I wanted to remind folks of. One, the webinar is designed for 30 minutes. We will hold a Q&A at the end. If you have a question, you should have a toolbar up on your screen to the right of your screen, and you will see on the toolbar further down a caret next to the word questions. You can click on that, type in your question, and send it to us, or either you can send it to the whole group. We will get to your questions at the end. The second item I wanted to mention again is that we are recording this webinar. We will post it within the next day or so. And so if you wanted to go back and listen to the recording and/or you weren't able to stay on for the entire amount of time, we will have it posted, and we encourage anyone, if you want to send it to a friend or a family member that is interested in Capital Management Corp, please do so. Our agenda for the day is we're going to start off with Mark discussing inflation, how the Fed may react to it for the rest of this year and going into next year, and what does it mean for the market. Tim will jump in after Mark and discuss how the inflation backdrop could continue to affect corporate America, and how CMC's cash cow approach is an advantage in this type of environment. With that said, I'm going to pass it on to Mark.
Thank you, Scott. Once again, one of the major topics in the market today, and it seems like it has been since the beginning of 2022, is inflation. This chart goes back to 2014, so we have roughly 10 years. The 2024 data is the April report. And so in April, the CPI showed that consumer prices were up 3.4% from a year ago. On a month-to-month basis, the April report was up 0.3% from March to April. That was actually an improvement over the February to March period and the January to February period, which were both up at 0.4%. So following the financial crisis, we've had a decade plus of very low inflation, and then the pandemic came and we reversed that trend quickly, and inflation has been increased massively since then. We believe the Fed will be looking for at least 3 months of tame inflation before making the first interest rate cut of this cycle, because inflation has been running much hotter than the Fed's 2% target over the last few years. Some areas of persistent inflation are shown on this slide. We talked in depth about shelter being the largest component of the CPI in prior calls, and that's been pulling up the overall inflation rate here recently, probably for the last 2+ years. We believe that the higher interest rates have somewhat unexpectedly kept housing prices high. Usually this is not the case. The normal relationship is when rates go up, home prices come down. However, what I think many didn't anticipate is that homeowners that have a mortgage that would have originated prior to 2022 are much less likely to want to move today and give up that low mortgage rate. For this reason, fewer houses are on the market for sale, which limits the supply of available housing. And anyone that's taken Econ 101 knows that if supply of something is very low and demand is stable or rising, the price of that thing tends to remain high or go up. So it's somewhat paradoxical, but the higher rates are keeping home prices elevated, I think in a way that was unexpected. Energy prices are also on this slide. These can be very volatile, and you can see, depending on which period you're looking at, on a year-over-year basis, energy was only up 2.6%, which is lower than the overall rate at 3.4 mentioned on the prior slide. However, if you look at it month to month, the March to April period was up 1.1%. So in recent times, and you may have noticed at the gas pump, energy prices have been increasing and led to higher month-over-month CPI. And services is the biggest sector, includes shelter, and is 5.3%. And we're going to go into some of the interesting areas of services on the next slide. And one of those, this slide shows some areas of recurring inflation. And the first we wanted to talk about from the April report was the automotive insurance sector. April showed a massive 22.6% increase from 1 year ago. So, 7 times roughly what the overall rate of inflation was. Auto insurance is a relatively small piece of the overall CPI, but this increase was by far the most in the April report. And we find it interesting because we think it's a good example of how inflation infiltrates the economy. It can become like a snowball rolling downhill. So if you think about the sequence of events, first you may have the materials to make cars go up in price to increase costs. Next, labor became more scarce during and following the pandemic and became more expensive. So the cost of putting the cars together went up, and that led to increased costs. You also had transportation costs rising, so it was hard to get ships, and the fuel to move the ships was higher in cost. So getting a car from the manufacturer and where it's manufactured to the customer can increase the costs. And then parts, aftermarket parts, and labor to fix cars goes up or had gone up as well. So in the end, you had cars more expensive, labor more expensive, and parts more expensive. So the overall cost of repairing a car or replacing it is much higher than it was prior as well. And so when the insurance companies are paying more for claims, they need to increase the cost of their policies to avoid operating at a loss. So this is kind of how inflation, you could think of it as a snake eating something, a mouse or something like that, and it goes through the body, and it starts at the beginning and goes through the end. And that's why you had a nearly 23% increase in the cost of auto insurance in the April CPI report. A similar story or trajectory could probably be told for housing insurance costs as well. I know a few of my clients that I've spoken to, and friends personally that I've spoken to that have gotten their insurance renewal statements in the late 2023 and so far in 2024 year have had a little bit of shock at the increase in the insurance costs. Food costs have also increased, although this year at a more modest rate. The most recent report, food was up 2.2%. The problem is the compounding impact. If we look back over the last since the pandemic, food is roughly 25% more expensive than it was in 2020. So the compounding, from 1 year to the next year to the next year, price increases on top of price increases on top of price increases, is leading to some consumer sticker shock in the grocery store and at restaurants. And we're seeing that with a beloved lobster chain recently going bankrupt. I think their prices kind of got out of control and their customers did not want to come anymore. Electricity prices were also up 5.1% in the April report. And electricity is one of those things that most people have to take the price. They don't change their behavior that much. So essentially, you're pulling spending from keeping the lights on or spending more keeping the lights on. You don't have as much discretionary income to do other things that you might want to do, like new clothes or vacations or something like that. And this next slide just shows the inflation pain that you may be feeling or that a consumer in the economy may be feeling. So on the left side, you have no pain, and on the right side, you have very bad pain. And the amount of extra or discretionary income any one given person has will most likely dictate their own personal pain felt through this inflationary cycle, whereas wealthy individuals may not need to change habits all that much to deal with higher prices. If you have less discretionary income, you might be forced to make difficult decisions to decide between what you really want or what you really need and what you simply want. For many consumers, wage increases have not kept up with the inflation of the last few years in total, meaning that real wages have fallen and discretionary income has fallen. So with less discretionary income, we're seeing some retailers showing fewer unit sales for sure, and some with falling same-store sales. So they might be selling fewer units at higher prices, but in total, they're not reaching the levels they were a year ago. Retail sales, excluding cars and fuel, fell 0.1% in April. So that's not a huge decline, but it is a decline nonetheless in a growing economy. So one way consumers can deal with inflation is to put more things on their credit card. And we've seen credit card balances rise meaningfully recently. The most recent report, credit card balances were up 129 billion with a B since the last year, now totaling $1.12 trillion with a T. So that's a pretty big percentage increase as well. There's some estimates out there that the average interest rate consumers are paying on those credit card balances are close to 27%. So if you think the Fed funds is high at 5.5, 27% on a credit card loan is outrageous and very difficult for people that are kind of forced into that situation. So as consumers are increasing their credit card balances, their interest expense takes up even more from discretionary income, leaving more customers feeling the pain on the right side of the slide, the orange and red, than being on the left. So how does the Fed react to this? This chart shows the ebbs and flows of the federal funds rate over the last roughly 40 years. So you can see that we're in a somewhat normal part of the cycle if you exclude the period following the financial crisis and the pandemic, which was the zero interest rate policy. So we're not particularly high based on longer term history, but we have certainly come a long way just in the last 2 or 3 years from 0 to 5.5%. At the start of this year, the consensus was for 6 rate cuts during the year, during 2024. But given the stubborn inflation trends, that consensus is down to just 2 cuts by the end of the year. The original expectation was for a March cut, and we're past March and we didn't get one. So we know that didn't happen. Here at CMC, we believe that with inflation still persistent and employment trends still positive, we don't think the Fed will be in a rush to lower rates. It's just hard to imagine why they'd want to lower rates with inflation still well above their target without a material slowdown in the economy, which we have not witnessed yet. So we would estimate either 1 cut or perhaps no cuts for the rest of the year, which is we're still kind of above consensus on rates higher for longer. And so that's kind of where we stand on our views on interest rates and why inflation has been so persistent and tricky. And once inflation gets into the economy, it's not that easy to tamp it out quickly. So now I'm going to pass the call to Tim to talk through some of how this macro data is influencing us and how this data aligns with our cash cow investing approach.
Thank you, Mark. Higher interest rates and rising prices have exhausted the consumer. For many, discretionary spending is stalling out and declining. Moreover, consumers are sick of higher prices. Firms cannot rely on price increases to grow sales or grow profit margins. Successful firms will grow unit sales through innovation and winning market share. Firms will also need to cut costs and enhance productivity. On top of this, excess cash generation is key in a slowing economy experiencing higher rates. But less than half of the publicly traded firms generate excess cash. We search for innovative, growing firms generating excess cash. Excess cash generation enables firms to pay down some debt as it comes due, and in turn, lower debt levels, resulting in lower interest expense, thus adding to earnings growth. Meanwhile, firms that cannot pay down debt will have their earnings hit with higher interest expense. Some of our growing cash cows generate so much excess cash they can also repurchase shares, boost dividends, fund internal growth initiatives, and seize attractive acquisition opportunities. We expect more out of the stocks we select: revenue growth, expanding profit margins, earnings growth, and above all, excessive cash generation. So much cash generation that most of our firms not only pay cash dividends, but also regularly increase them. This further adds to shareholder returns. Examples of recent dividend increases include Alphabet, which is also called Google. It recently initiated its first dividend. Altria, meanwhile, announced its 54th consecutive year of annual dividend increases. Prudential had temporarily paused its dividend increases at the beginning of the financial crisis, but has had 16 annual dividend increases since. Qualcomm has also had 16 annual dividend increases since initiating its dividend. All four of these firms happen to generate so much excess cash that they can also fund share buybacks, reducing their shares outstanding. The higher for longer interest rate scenario puts pressure on lots of companies. As I said, less than half of the publicly traded firms generate excess cash, even in good years. Wall Street loves those companies. They make fees from issuing vast array of new bonds to fund these firms' existence. However, all of this debt eventually needs to be refinanced. Most corporate debt is issued for just 5 to 7 years. As seen on this chart, a great deal of corporate debt needs to be refinanced now. This debt was issued when interest rates were close to zero, but now that the time has gone by, it has to be refinanced at much higher rates. Some firms with negative cash flow will not be able to refinance. They will face bankruptcy. Luckily, one is not forced to own index funds that contain cash burners. In this environment, it will pay to be selective. Here we highlight some of our holdings. These media, energy, and electronics firms are generating so much cash that they can pay down debt while repurchasing shares. So their balance sheet is getting stronger, earnings per share growing, and you have fewer people you have to share your profits with. Stocks generating excess cash can also fund their future expansion. ONEOK and Kinder Morgan are extending their intrastate pipelines to new power plants that are required by the new AI server farms. Bristol Myers has been acquiring drugs for their R&D pipeline, while acquiring other stations. Gray has also rehabilitated over 100 acres near Buckhead, which they call the Atlanta Project. This $600 million investment has no debt and has just started generating revenue. Acme is over 150 years old. Under the current CEO, Acme has entered the healthcare and first aid kit markets with a few acquisitions, including Elite First Aid Only, First Aid Central, Pack Kit, Physicians Care, Safety Made, Hawktree, MedNap, and Still Magic. Of course, they can make custom first aid packages for many industrial companies and retailers. On my most recent trip to Acme's main warehouse, Home Depot was one of the store label kits being mass produced that day. On that visit, I also noticed numerous productivity improvements. Well, Acme entered healthcare in 2000, and now that division represents over 60% of the company, increasing profit margins and growing the company at a faster rate as it wins market share. Some of this is also through innovation. One recent innovation driving healthcare sales for Acme in the industrial setting is the smart cabinet with barcode technology and remote data connections. This helps to boost replenishment sales and allows companies and big industries to easily implement federal regulatory mandates. We expect holdings like Acme to deliver strong double-digit sales growth and even stronger earnings growth. We are looking for high-quality, innovative firms, winning market share, and generating excessive cash and profits relative to their size. Select companies will be rewarded in the years ahead. Many other companies will be trapped with heavy debt burdens. What if your 5-year, 2% mortgage came due and it needed to be refinanced at over 7%? But the bank says, hold on, these days we need more equity, larger down payments. Well, many firms face that situation today, but without the beautiful house that it has appreciated in value. If these cash burners are lucky enough to refinance, they'll be at much higher rates with tougher terms. They might even have to give away part of their firm in the form of stock warrants. That is like refinancing your mortgage and giving the mortgage broker part ownership of your house. Well, this is a great environment for selective stock picking. And we have select stock portfolios adhering to time-proven disciplines. We're very excited about the future. Now back to Scott.
Thanks, Tim. Okay, we received a couple of questions beforehand, and let's get started with the Q&A. Excuse me, first question is, I have read companies won't be able to raise prices like you said. What's your investment outlook because of that?
Yeah, so I think you really have to look at individual companies in this environment. If the consumer is tired of price increases, which we think they may be, they will be more selective in what they buy, and you may not be able to increase prices and help revenue growth and maybe margin growth on top of that. So you really have to take a specialized approach and know the companies very well. And companies will grow through innovation. So if you have a great product that people want or people need, we think you'll be able to sell it very easily. But if you have a product that's more of a commodity or something, you'll have a harder time being profitable in that sort of business. So that's why we take the approach that we get to know the companies very well and are very excited about some of the opportunities in front of them. So we do think a more selective approach is going to be appropriate going forward.
Second question is, how real is all of this talk about AI and how affects your strategy?
AI can be is being used by many companies. It has been for a long time, and the trick with any new technology is learning how to use it to receive some benefit. That's going to take a long time for many industries when it comes to AI. But if we were all to use AI as Silicon Valley would advertise to us, all of the servers needed and constantly running servers would basically double the need for electricity in the United States. There's not enough power production for that. As it is right now, a lot of utilities are limited in what they're allowed to build in power generation, and we expect several cities to experience blackouts this summer. So how are you going to use twice as much energy for all this AI? But we do have Kinder Morgan and One Oak, and they are building pipelines to where new electric generation plants need to be built for all of these server farms. The server farms have so many servers, they're creating lots and lots of heat. So a lot of these need more than just a fan. They need, new carrier systems to air condition the entire complex. So you have the electricity needs for the servers, but then also to air condition the whole area. And you need innovation and technology in order to preserve all the water that's needed and be able to recycle that. So in various ways, many of our companies are able to take advantage of these future trends in AI. And meanwhile, we have Qualcomm and InterDigital that have patented a lot of the technology needed, and so they get royalties when that patented technology is used. Luckily, they're more than just AI. They not just supply the cutting edge technologies for servers, PCs, and tablets. They also have the key technology for 5G, 6G, future automobile technology, the IoT, which is the Internet of Things, and CE, consumer electronics. They are leaders growing in that space, and their revenue and earnings trends show it, and they will be companies like that with recurring revenue and earnings growth and rising profit margins tend to get handsomely rewarded over long periods of time in the market. And we're looking forward to many years of long-term compounding. And part of that will be from receiving the benefits of the creation of more AI and companies learning how to use it to increase their productivity, their output, and their profits.
We had another question about AI, but I think you addressed it. Another question we have is, NVIDIA has more than doubled. Why doesn't CMC own it?
Well, in retrospect, it would have been nice. So NVIDIA has been a very successful company. I will note NVIDIA has fallen 80% in a given year period, twice in the last 10 or so years. So it can be a very, very volatile stock. And generally speaking, one of our main things we pay attention to when we're purchasing stocks is valuation. And the valuation of NVIDIA is very, very high right now, over a 50 times PE ratio, where our portfolios are closer to 10 to 12 times PE ratios. So we don't want to pay 5x what the portfolio is for a company. The excitement around AI currently has almost 100% gone into NVIDIA, and we don't believe that that will be the only winning company in AI over the long term. Tim mentioned a few different areas that we are invested in that may benefit from AI, and we just think the benefit of AI, if it does come through, will be more broad-based, and if it takes longer to come through or stumbles in some way, we think NVIDIA is at great risk. Technology companies and chip companies are also notoriously volatile, and that economic moat around that business is the narrowest and shallowest in most industries, meaning that technology firms can also get leapt by other technology firms as things get better and better. And the way competition will work, if other companies see, or other governments even, see NVIDIA making a ton of money, they will work hard to compete with them. It may end up leaping them in the future. And we just don't want to be in a situation where we're holding a company where there's almost all positive press and positive investor sentiment at this time, and it seems like it's priced for perfection. And we've seen in the past with not only NVIDIA itself, but other companies, when you get priced for perfection and things don't go exactly perfectly, you can see a massive drop in a relatively short amount of time. So that's why we haven't been in it and continue not to buy it up here.
We've seen these tech bubbles before. People get very excited, say, well, this time it's different. We have to own these at any price. In 1972, that was Kodak, that was Polaroid, Xerox, and you didn't do too well. In the 1980s, it was IBM, and then it took quite a break. At the peak of the last tech bubble, you had to own Cisco Systems at any price. You had to own Intel. 24 years have passed. Those companies are still around. They're still leaders. They're still big. They're at lower stock prices today than 24 years ago. No stock splits. So you had to own it, no matter what the valuation metrics were. And, before dividends, you've now had a 24-year negative return. That's not preserving wealth. That's not growing for the future. Entry price matters, and you can be paying too much for some of these stocks, especially when it comes to chip firms. They can be very volatile. Sometimes customers double, triple order, and then they don't need you for a while. So NVIDIA, as Mark said, has gone down 80% or more, 2 different years. You have to go up over 400% to get back to where you started if you lose 80% or more. That's not the risk our clients want to assume.
Thank you. I think that's all we have for questions. Again, I'd like to remind everyone that we have recorded this webinar. We will be putting it up on the website in the next day or so. You will receive an email. We want to thank you for attending today's webinar, and have a great day and rest of the week. Thank you.